Hello, everybody. Mike Sorrentino here, again, along with Bepin and your most recent edition of Market Pulse. And of course, much to discuss. Although, as I think you'll see, our view of this is that it's a mile wide and I don't even know if it's an inch deep, frankly, Bepin. But it's certainly there's a fear du jour out there, and there's always something. And I would say right now, we got a good one. So let's go ahead and jump in. I will give you a disclaimer before we start today. I don't want to speak too much for Bepin, but I am not a geopolitical expert in the Middle East. I know
Oh.
virtually nothing about Iran because for the last, call it half century, we haven't been allowed to visit there. So let's
You've
just
ever
take this
watched
with a grain of
Argo?
salt. Yeah, Argo, that's right. I forgot about
Yeah.
Argo. Yeah, the movie they got a best picture for showing how great the movie industry was,
Yeah.
saving some people. Yeah. Minus the sarcasm. So let's get into from Warren Buffett. Widespread fear is your friend as an investor because it stirs up bargain prices, and that's going to be a key theme today. A very interesting theme that we can almost quantify to a certain degree by looking at key metrics in markets. But first and foremost, what's going on in Iran? I don't know. I can't tell you. I think it changes every 12 hours, or maybe even 12 minutes these days. But what I will tell you is I have a little bit better understanding of what it's going to do to the U.S. economy. And that is, in my opinion, very, very little. At the end of the day, there's a lot of talk about the Strait of Hormuz and however you want to pronounce it. I know there's different pronunciations out there. But my point here is that that's that little area in the upper right hand corner. You can see where that water is flowing. That little area that goes around in Iran has become problematic in that region. I'll just leave it at that. Not a lot of ships are getting through. We've got a lot of trade, a lot of oil that gets through that area. And I want to be abundantly clear about what's going on in that region right now. There's a lot of press, there's a lot of fear and a lot of panic out there. I know we're seeing gasoline prices rise, but look in the lower right-hand corner on the right-hand side, okay? The destination, meaning the stuff that's coming out of that strait. The bottommost portion, you see US at 2.5%. That is saying that only 2.5% of the oil coming out of that region is coming to the United States. It's a very, very small number. And I don't want to sound callous, I don't want to sound dismissive, but from an economic perspective, there isn't much impact of what's happening in this part of the world right now on the US. I get oil prices are rising. I get there might be some ancillary inflation that might be happening, that might be temporary. All right. I get that. But I don't think that's going to be long lasting. And if you see what's going on in oil markets right now, Bepin, I mean, the volatility is insane.
I
So,
know.
I mean, I feel like a tweet comes out and the oil crashes 20%, right? So, I like to relate these types of environments to a hockey fight, right? I mean, people throw their gloves down on the rink and get into it, right? I found like the best way to survive a situation like that is just to let them just fight it out. They're going to get tired and then it's going to end. Getting involved has very little upside. So, from a trading perspective, what we don't want to do is we don't want to sit there and try to time and get active in a hockey fight like this because you're going to get hurt. So we don't necessarily view this as a trading opportunity per se. If we started to see a massive dislocation one or the other, yes, we'll certainly take notice and potentially take action. But to try to trade through this type of volatility is financial suicide. So we look at the situation. I know there's a lot of media, a lot of press, but ultimately there's very little long-term economic impact coming from this part of the world. It's not 1980 OPEC anymore.
As we know, though we believe this is to be short-lived, there's obviously volatility in the market. And when uncertainty rises, people tend to sell. What you're looking at here is a chart of the S&P 500 overlaid with a chart of the VIX, which is the volatility index, also known as a fear index. And a little technical here, but how it gets calculated is with option prices, primarily put prices, which are a protective option. So if the price of the S&P falls, you kind of locked in a price there. And as the price of that protection goes up, the VIX tends to go up. And the reason being is if people are paying more for protection, is because everyone's very scared. The point of this chart, though, is to highlight a couple zones in here that tend to be great buying opportunities. Now, what Mike was talking about earlier is like day trading this is impossible. Look at the spikes, the jaggedness of this. It looks like a saw. Um, so day trading this and trying to go in and out of the market is not ideal, nor is it recommended by anybody. But if you are a long-term investor, there are some key levels that you want to pay attention to. The first of which being this green line that you're looking at here. And the reason we chose green is because it tends to be good for the future if you buy when the VIX is above 30. Uh, but there's also another zone in here, and we actually breached it on your chart here. If you look over to the left, that's Liberation Day, right by April there. So you see that huge jagged spike that topped above 50. I don't know where it exactly got up to, but like 52 or something. But the point being is if it's above 50, these are almost generational buying opportunities. They don't come by very often. And the next two charts here, you'll see why these two levels are just are great indicators for times to buy and obviously for a long-term investor, because as you'll see, the measures of return that we're going to look at are in years, not in days, not in quarters. So that first level we were looking at here was when the VIX is above 30. The chart you're looking at here is at the highest 10% of VIX levels, 28.3. We'll go ahead and round that up to 30. The dark blue lines you're looking at is all other VIX levels, so anything below that really. And as you can see, the light blue line is across the board ahead of the all other VIX levels. So it tends to reward investors who are willing to buy and hold during these time periods. So we like this famous adage here that we mention from time to time, but you want to buy when the VIX is high, and when the VIX is low, look out below. And now taking it back to Liberation Day, a walk down memory lane. It feels like forever ago, but ironically, here we are dealing with another bout of volatility. Granted, not nearly as high as Liberation Day, but still, it seems like April has a very and when you think back to even COVID, some of these other line items in here, April just tends to not be a great time in terms of investor sentiment. People tend to panic around this time of year. But what you'll notice here is we finally have a 1 year reading. So that red box is highlighting the Liberation Day. I believe this is the day before we got the pause. And it shows the 1 year forward return and 38%. I mean, you've all seen it. You've all been in the market for this time period. It was a absolutely great time to buy during Liberation Day. And the reason being is the VIX being above 50. People heading for the exits, max uncertainty, the time when you're watching the rest of your portfolio take a nice dive, whether it be 20%, 30%, is usually the best time to be looking under the couch cushions and under your mattress to pick up some extra money to uh, go buy equities. And this bottom red box you're looking at here is breaking down the different readings here. So looking at the average return of you when you bought if you bought when the VIX was above 50 versus if you had bought when the VIX was below 50. And I mean, the differentials you're looking at there, those are real wealth builders. So taking it back to kind of the original quote that we brought up with Warren Buffett, this is what he was talking about, is uncertainty is the friend of a long-term investor. If you are willing to step into the market when your stomach feels a little uneasy, that tends to be the best time. I think they always say your money, all your money's made in bear markets or in periods of panic. It's usually not made at the top of the bull market. And speaking of bull markets,
Yeah, yeah. I think what I find interesting about these periods that we go through, Bepin, is that I refer to them as kind of air pockets, right?
mhm,
They're scary. And I think you can't prove it, but I think that there's a commonality across most of them. I mean, you talk about Liberation Day. Now we're talking about Iran. What are some of the consistencies that are in place other than the tweets and all that other? Let's push that
fear.
aside. I think,
Yeah, it just seems to be
yeah,
fear, uneasiness.
fear, and I think really what is that? What instigates or what causes a lot of this? Yeah, it is fear, but I think what drives that fear? Well, one, look, think about how much money people have made over the last year. All right. I mean, or extended out the last 5 years since 2022. People are up and up big in equity portfolios if they were strong and held in, right? So
Yeah.
you've got gains, you're looking at those gains, you don't want to lose them, all right? So there's a psychological component to that. And if you're trading, well, what happens then? You lever up, right? You've got margin accounts, you got margin balance. People are doing things that the greedy people tend to do. And what happens? Something comes along like tariff talk, which we
Hmm.
discussed extensively last year. This year it's Iran or whatever it might be, the fear du jour,
It'll be
and they
something else
immediately
next year.
there's going to be something. There always is,
Mhm.
right? And they
Yep.
latch onto, and what happens? It causes a massive dislocation. The VIX spikes, people sell off, and that air pocket is hit. And what happens when VIX gets above 30, or when it gets even higher to 50, whatever it might be? It
Hmm.
creates that buying opportunity you're talking about, Bepin, is because you've shaken out all the fear, all the panic, and the only thing that is left in a good economy is the foundation for future growth. And
Hmm.
this happens over and over and over again. So from that perspective, this is the reason why we maybe not necessarily trade in this stuff, but we watch it because human behavior never changes. And that's the
No.
reason why we feel confident in investing. And it's the reason why this chart you're seeing on the screen right here is so interesting. Again, we know that past performance does not predict future returns. We know that. But I like to say that history often rhymes for a reason. And if you look at this chart, what I find to be very, very interesting is that the old adage, the bull markets don't die of old age. Okay, they don't
Mhm.
operate on counters, and once a bull market turns three, as you can see here, and when I say three, 3 years long or 3 years old, it usually gets to four. And if you go back here over the last several bull markets, going back at this point, 80 years. Oh no, that's not true. 70 years, 75 years, whatever it might be. As
Oh,
you
you're
can
pretty
see,
close.
each one of these bars represents a bull market at that time. And most of them, especially in modern history, most of them have gone on for quite some time. I will say that the there are many reasons I think why these bull markets not only have last a long time, but I think what's more interesting is the duration of the bull market. I think on average is rising. Okay, so the average you get to three, or you make it to three, you usually get to four, but the length is actually getting longer and longer as we kind of move on. And I think one of the reasons why that's happening, frankly, is that our economy is getting stronger, it's getting larger, but also I think that the lessons learned of past mistakes get incorporated into future monetary policy and fiscal policy, and those ultimately help. Um, there might be a little bit of cynicism that you could add in, bake in there, Pepin, as well, and say, well, we just print more money. But
No.
ultimately, you could say that, but it doesn't change the fact that the bull markets do seem to be going for longer than they were 30, 40 years ago.
No, and exactly as you were mentioning, it's not just like the monetary and fiscal policy that gets adjusted as corporate policy. We talk about it all the time. How many changes came across corporate plans after '08? How much financial discipline around the entire S&P 500. So you just have fundamentally stronger companies. We have a far more diverse economy. We created a new we created a new whole like section of our economy with AI. Yes, it's tech adjacent, but this is a brand new sector of our economy that's growing rapidly. Think about all the infrastructure build out that's associated with it. And sure, there are headlines here and there about, well, it might not be as much as we originally thought, but it's still in the trillions of dollars. And that's happened what in the last 2, 3 years, Mike?
Yeah, yeah,
Out, out,
it's just
out of nowhere. And you have trillions of dollars getting spent on the US economy and even the global economy. So the fundamentals are intact. And again, I think we really just want to highlight we don't think the Iranian situation or really many other fears that are circulating around the market are going to change the fundamental nature of these businesses and their earnings per share. I mean, we're looking at Q1 earnings and they're solid across the board. So it's just until that changes, there is no bull markets aren't dying of old age. They die of earnings collapses.
exactly. And you said it perfectly. If you look at right now, the forward earnings estimates and what's actually coming into the door, earnings are rising right now. So there's only two components of a stock price, right? There's the earnings and then the valuation, how people view those earnings. And earnings right now are rising. across the board. Not everywhere, not every company, obviously, but in aggregate, the earnings are rising. And if the stock prices are going down while earnings are rising, that just tells you this is nothing more than emotions, pure and simple.
Feeling queasy. Yep, exactly.
With that, my very simplistic advice is to hang in there. I really don't think, again, I'm not an expert in geopolitical warfare in the Middle East, but I don't see any reason why this situation is going to cause irreparable or even long-term damage to the U.S. economy or the asset prices that we all invest in. I think it's going to be a typical, what I call MAD situation, market attention deficit disorder, MADD. All right. We're going to see this for a while. And then one day people are going to wake up and be like, okay, I'm bored with this conversation. Let's move on. If you need any evidence to this potentially happening, look at every other conflict we've dealt with over the past 30 years, every single one of them. You can go to the October for Israel 2 years ago, or maybe 3 years ago at this point. You can go to Russia, Ukraine. It was very scary, made a lot of news for the first few months, and then markets get bored. It's that simple. So with that, I want to thank everybody for listening in and have a great weekend.